Alright, let's dive straight into this. In today's explainer, we're unpacking a massive financial mystery that's literally hiding a completely fascinating contradiction. So today, we're going to break down the exact mechanics of how this is actually happening, and more importantly, the massive financial trap that's catching millions of people completely off guard. You see them all over the highway. We're talking about these gleaming, massive monsters with chrome everything and luxury leather seats that probably cost more than your monthly rent. A lot of times, these vehicles cost more than the median household income. But here's the catch. The people driving them aren't crypto billionaires, and they definitely aren't trust fund babies. They're teachers, nurses, mechanics, office workers, just regular folks with regular jobs. So how on earth are they signing on the dotted line for something that seems to completely defy basic math? Well, the truth is, there's an entire system perfectly designed to make these seemingly impossible payments look, possible. To really wrap our heads around the scale of this, we have to look at the numbers. The average new car payment recently crossed the $700 mark, which is staggering all on its own. But when you look at trucks and SUVs, which, let's face it, have basically become the default choice for American buyers, these payments routinely blow past $900. In fact, it is not uncommon at all to see monthly payments hit $1,200. Just think about that for a second. $1,200 every single month for 6, 7, or even 8 years. And that is before you've pumped a single drop of gas into the tank. Now what's really wild about this is how it totally exposes our psychological blind spots. Think about it. If a friend told you they were spending $1,200 a month on coffee, you'd probably stage an intervention, right? If they dropped that much on clothes every month, you'd assume they had a severe shopping addiction. Yet somehow, when it comes to a vehicle, society just kind of nods and says, well, you gotta have reliable transportation. We have completely normalized a massive, life-altering expense simply because it happens to have 4 wheels and an engine. So let's move into our first segment section, the extended loan illusion. Let's peel back the mechanical tricks the auto industry uses to fake affordability. It all kicks off with the absolute death of the traditional 3-year car loan. The industry basically fakes affordability by stretching loans to the absolute limit. Say you walk into a dealership to buy a $60,000 truck. A standard 4-year loan might demand a brutal $1,500 a month. So what does the dealer do? They just extend the loan out to 8 years. Suddenly, the payment drops to $900. As a buyer, you focus entirely on that smaller monthly number and feel this huge sense of relief. But here's the illusion. By extending that term, the total amount you actually pay skyrockets from $72,000 to over $86,000. You are paying a $14,000 premium just for the privilege of a lower monthly pay leads us directly into a brutally vicious cycle. See, when you take out an 8-year loan, the car appreciates way faster than you're paying off the principal. So by year 4, you're tired of the car, you want a new one, but you owe significantly more than the vehicle is actually worth. This is what's called negative equity. Dealerships, they love this. They simply take that negative equity and roll it into an even bigger loan for your next car. You basically become trapped on this financial hamster wheel, constantly paying for cars you don't even own anymore. It makes the dealership a customer for life because you literally cannot afford it. And that'll break the cycle. You'll also frequently see those giant promotional signs screaming 0% APR for qualified buyers. I mean, it sounds like free money, right? Who wouldn't want that? But the reality is, the cost of that financing is already baked right into the car's sticker price. Usually, you're either paying the full sticker price to get that 0%, or you take a massive cash discount and pay a normal market interest rate. You don't get both. Plus, the people who actually have the pristine credit required to qualify for these 0% offers, they're typically the ones who could just pay cash for the vehicle anyway. Which brings us to section 2. Selling lifestyles, not just transportation. So why do totally rational people take on such crushing debt? Because the auto industry doesn't actually sell transportation anymore. They're selling dreams, identity, and social status. They know exactly how to trigger our emotional responses. When you see a commercial for a truck, they aren't selling you a reliable way to get to the grocery store. They're selling you the fantasy that you are successful, rugged, reliable, hardworking. And this brings us to a really fascinating psychological condition. People develop what is basically automotive Stockholm syndrome. They become intensely emotionally attached to their financial captor. The truck becomes a physical reward for their hard work. If you suggest to someone that they could save hundreds of dollars a month by just driving a reliable used car, they don't hear practical financial advice. They hear a direct attack on their self-worth. And they will defend that truck payment with incredible passion. This brilliantly illustrates the emotional manipulation at play here, and it is incredibly potent. It turns a ridiculous $900 monthly payment into what feels like an investment in your own identity. The industry is brilliantly selling this intense mountain climbing fantasy to someone whose idea of off-roading is, parking on the grass at the county fair once a year. Even if your daily commute is literally just perfectly paved roads from the suburbs to the office, you're paying a massive premium just to feel like an explorer. Alright, moving right along to section 3. The hidden cost trap, because finding an extra $700 to $1,200 a month is incredibly difficult for most people. They end up performing insane financial gymnastics just to keep these vehicles in their driveway. To afford these monster payments, people are essentially restructuring their entire lives. They're literally eating ramen noodles for lunch while driving a vehicle that costs more than some houses. They're moving to smaller apartments, they're skipping family vacations, and they're driving for rideshare companies on their weekends just to generate the extra income to pay for the truck they use for the rideshare. And most disastrously, some are even borrowing against their 401ks. They are sacrificing their actual future retirement to fund their current transportation fantasy. It's kind of like a modern form of indentured servitude. And the crazy thing is, the payment is just the beginning. Buyers completely underestimate the hidden operating costs. Insuring a heavy, expensive truck requires premium coverage, which easily tops $200 a month, and for multi-car families that can easily hit $500. Then you've got fuel. Driving a heavy brick that gets 15 miles to the gallon, that means gas costs can easily reach $400 a month. And what happens when these highly complex, tech-heavy machines need a simple brake job? Boom! That's $800 to $1,200 out of pocket. If you don't have an emergency fund, that repair goes straight onto a high-interest credit card. Let's look at section 4, the brutal reaction of the math. Let's calculate the absolute reality here. We're going to strip away the emotion, strip away the slick marketing, and ignore the shiny chrome. Imagine purchasing a typical $55,000 truck on a 7-year loan at a 6% interest rate. Over those 7 years, the initial $800 monthly payment might feel somewhat manageable. But when you look at the total life cycle, oh boy, you pay $67,000 just for the loan and the interest. Add in $21,000 for insurance, $29,000 for fuel, and a very conservative $15,000 for maintenance. That $55,000 truck is actually going to cost you $130,000 out of pocket over 7 years. And what exactly do you have to show for it at the end of those 7 years? After sinking $130,000 into this machine, you're left with a depreciated asset that's worth maybe $15,000? This isn't just a poor return on investment, it is quite literally wealth destruction with heated seats and cup holders. You are hemorrhaging money on an asset that is mathematically guaranteed to lose its value. So the absolutely crucial point here is the opportunity cost. What if, instead of destroying that wealth, you actually built it? If you took that exact same $800 monthly payment and invested it in a simple index fund returning 8% annually, after those same 7 years, you wouldn't have a rusty $15,000 truck. You would have